So we have analyzed certain transactions of routine nature like purchases, sales, infusion of capital or introduction of capital, credit sales, cash sales, payment by check and so on. So that is the preliminary stage of bookkeeping or accounting, which is technically called journalization. It is called journalization because it is involving entry into the journal, which is the basic book of account. In this session, I propose to take up certain cryptic transactions, certain peculiar one-off transactions which do not occur on a routine basis in the case of a business. How is that accounted? So taking the cue from our previous session on classification of accounts, applying the rules, let us revise them. We have 3 types of accounts, throwing up 6 different accounts. Personal accounts, debtor and creditor. Real accounts, asset and liability. Nominal accounts, expenditure and income. The rules applicable respectively are: 1 for personal accounts, debit the receiver, credit the giver. For real accounts, debit what comes in, credit what goes out. For nominal accounts, debit all expenses and losses and credit any incomes or gains. We have seen that this perfectly fits into, it is tailor-made for any kind of a business transaction. I am taking up certain peculiar transactions now, like for example, to begin with, insurance. What is the principle of insurance? You pay a premium every periodic frequently to receive a lump sum assured. Maybe after a period of time or on the happening of an event, occurrence or non-occurrence of an event, or the expiry of a certain period of time, whichever happens earlier. So in the case of an insurance, it is involving a policy for which a premium is paid by the insured to the insurer to obtain a lump sum, technically called the sum assured. So when insurance premium is paid by a business, what is it normally for? It is to protect against losses by destruction. Insurance for loss of stock, insurance for loss of profits, insurance for a fixed asset, insurance for key managerial personnel, fidelity insurance. So there are different types of insurance in relation to the business area. In relation to personal insurance, it is normally health insurance or life insurance. Now, when a business takes up an insurance policy to, let us say, protect its stock against destruction by fire or natural disasters, normally an insurance premium is paid. And this premium is always for a certain specified period of time for which the policy is kept alive. So in an insurance, the typical technical terminology involved are policy, the document through which the entire terms and conditions are documented, premium, the periodic sum which is paid, let us say once in a month, once in 3 months, once in 6 months, annually, periodic amount paid to revive or keep alive the policy. Insured is the person whose property or life is insured. Insurer is the insurance company. United India Assurance Company, Life Insurance Corporation, General Insurance Corporation. It is called the insurer. And the lump sum which is agreed to be paid on the happening of a particular event, 10 lakhs, 20 lakhs, 60 lakhs, 1 crore, whatever. Now let us come to the accounting implication of an insurance policy or the insurance premium which is paid. In an insurance, technically the premium is paid by way of, let us say, a check or cash periodically. Taking an example, let us say a business enters into an insurance policy to protect its stock or fixed assets and pays the premium every year on July 1st and January 1st. Each it's a payment of rupees 40,000. So in a year, a total of rupees 80,000 is paid as the premium. The payment is made on July 1st and January 1st of every year. I took July 1st first before January 1st because we follow the financial year system. Remember, in a financial year, July comes before January. It starts with April and goes on up to the next succeeding March. Now, when the insurance policy or the insurance premium is paid on July 1st, involving an amount of 40,000, let us say by check, the account which is debited is insurance premium account. It is an expenditure. In an expenditure, the debit arises. So insurance premium account is debited. And where the payment is paid by check or made by check, bank is credited. So insurance premium account debtor to bank account 40,000 being insurance premium on policy number so and so, dated so and so, paid for the period so and so. Now we must remember, when the insurance premium is paid on July 1st, this is half yearly payment. It will cover July, August, September, October, November, December. 6 months. So for 6 months that the policy will remain in force, the premium is paid on July 1st amounting to rupees 40,000. It expires on December 31st. Let us say December 31st, 2020. The policy has to be revived. A premium has to be paid on January 1st. So the next premium is paid on January 1st to keep the policy alive for the next 6 months. That is January, February, March, April, May and June. So legally June 30th it expires, July 1st you pay for the next 6 months, and this cycle continues. Of course, with a grace period of time, waivers in certain exogenous situations. So this is the principle. Now, when the amount is paid in July, it is fine. Insurance premium account debtor to bank account. When the amount is paid in January, you would have debited insurance premium. The entry passed would be insurance premium account debtor 40,000 to bank account 40,000 being insurance premium paid for policy number 3467 for the period, this is on July 1st, 1/7/2020, for the period July to, or let us take it as January, 1/1/2021, for the period January to June 2021. This is how we pass the entry, applying our principle. right? Insurance premium account debtor 40,000, to bank account 40,000, being insurance premium paid by check for policy number so and so for the period January to June 2021. The amount is paid in January. January passes, February passes, March passes, and let us say we fast forward our life to March 31st. Today is March 31st. As of March 31st, 2021, I have to close my books of account. Just like the business, accounting is also a continuous cycle. So we have to splice it to different periods. So while accounting for the financial year 2020 to 2021, I have to cut off on March 31st. So on March 31st, I recognize that out of this 40,000, there is a part which pertains to the next 3 months. In other words, out of this 40,000, 20,000, let us say it is 20,000 for 3 months. 20,000 is for January to March, and 20,000 is for April to June. But the entire 40,000 has been debited. Debited to the insurance premium account, credited to the bank account. So I have to pull out 20,000 from here because it does not pertain to my period. It does not pertain to 2020-21. So what is done? But the amount has been paid. The check is for 40,000. Now what you have to do is to pull out 20,000 from this insurance premium account and put it to advance paid or insurance prepaid account. Remember, the 3 months of the next accounting year, this insurance premium has been prepaid. So I would credit the insurance premium account and debit prepaid insurance account. Prepaid insurance is an asset. It will appear as an asset in displaying my financial position. And we have a peculiar situation where an expenditure, insurance premium account, is credited. Expenses are usually debited. To remove a component of debit, we need to credit it. So the entry passed or to be passed on 31st March 2021 would be this correction. So let us say I am posting the entry for 31st of March 2021. The entry would be prepaid insurance account debtor to insurance premium account 20,000 only. Being prepaid insurance recognized or accounted. So out of the 40,000, so what happens effectively in this year? My insurance premium account will have a debit of 40,000 and a debit of 40,000, now a credit of 20,000. So effectively 40,000 plus 40,000 minus 20,000, which is 60,000. Now this happens because insurance is a time-based element. Insurance is always paid irrespective of your accounting period. Insurance is paid according to the time covered by the policy. So in such a case, insurance is credited. Insurance premium account credited. Remember, although this is an expenditure. And prepaid insurance is debited. Now let us go one step further on this. The next premium was due on 1st of July 2021. When that is done, I will again make a payment, insurance premium account letter, to bank account. There, this will have to be reversed. What will you do there? Insurance premium account letter to bank account to prepaid insurance account. So that gets balanced or counterbalanced. That gets reversed. So this is about the insurance paid during a year. On 31st March of that financial year, you have to take into account any advance payments done. So these advance payments will take on the color of a prepaid account. So that is prepaid insurance. So this is the treatment for insurance, which is a time-based transaction, and the time-based not matching with our accounting cycle of April to March. It pertains to a different accounting period, not considering the financial year in the first place. So that is one peculiar account on insurance, where you remove the element of prepaid insurance or prepaid expenditure to reflect correctly the expenditure pertaining to the financial year. Let me take another example of stock lost by fire. $40,000. It might or might not be covered by insurance. So I have a raw material, I have certain consumables, certain input to be converted into output, which is lost by fire, 40,000. There is no cash effect to it. I have not paid anyone or received from anyone. 40,000 is a monetary loss suffered. A fire has occurred in the godown or in the store, in the warehouse, and goods, inventory worth rupees 40,000 is lost. Now, strictly speaking, you have to debit an expenditure called loss of stock by fire and credit it to the purchase account. So the entry would be, let us say this happens on 15th of June 2020. Loss of stock by fire account, debtor 40,000 to purchases account 40,000. Being goods lost in fire and covered by insurance. So maybe the insurance entry would come next. So here the credit goes to purchases account. So there is an expenditure newly come in, or the expenditure which was previously booked. Remember, when these goods were purchased, my entry was purchases account debtor being an expenditure, to cash if cash is paid, to bank if a check is given, to creditors account if it is on deferred payment basis. So the original entry passed was purchases account debtor to cash or bank or creditors. Now it is out of that stock that the goods are getting lost in a fire accident. So it becomes Loss of stock by fire account debtor to purchases account. Because we don't open a goods account as such. All the goods are routed through the purchases and sales account. I purchase goods worth 40,000, or let us say 1,50,000. Carry out a manufacturing process on that, paying wages. And 1,50,000 worth of purchases are sold for, let us say, 2,20,000, adding a profit margin and all the other overhead expenditure on it. So this is always at the cost. The cost of the goods which have been lost, because it is still at the input stage. Had it been finished goods which are damaged or lost, then I would take the selling price of it, including the markup or the profit element. So loss of stock by fire account debtor 40,000, to purchases account 40,000, being destruction of goods by fire, goods lost by fire, and insurance or covered by insurance, not covered by insurance, whatever. So that's a new account that we see. The new account we saw in our previous special case was advance, it is prepaid insurance. A peculiar account because it takes the nature of an asset. And this is loss of stock by fire and expense account. It's a loss account. So this is the second peculiar transaction. It doesn't happen on a daily basis. That is why I call it a peculiar transaction. So insurance premium accounting for. Loss of goods or stock or inventory by fire accounting for. The second one. The third transaction that I propose to take up is drawings from the bank account. I have deposited some money in a bank account. A week later I would like to withdraw some money from it. Then how is the accounting done? So I will call it as the drawings from a bank. Withdrawal from a bank, technically speaking, how would that be accounted for when you pull out money from a bank account? Depositing money into a bank account, the entry is bank account debtor. Why the bank account is debited? Receiver. The bank account is a personal account. Debit the receiver. Bank receives it and cash goes out. Real account, asset account. Now, when you pull out money from the account, let us say in the case of a sole proprietary business, the question arises, what are you pulling it out for? For example, I am a practicing chartered accountant. I have a current account. The balance in my current account, let us say, is about 92,000. I am drawing 20,000 from it by ATM, by check, whatever. When 20,000 is withdrawn, the question arises, do I propose to use that in my profession, or is it for my personal purpose? So, a withdrawal from a bank could be for business or personal purposes. I need to classify that first. If I want to withdraw from the bank 20,000 and invest it on professional books, a subscription for professional journals, acquiring a computer spare part, an ancillary, for purchasing a particular table lamp, for purchasing stationery items, then it is for the business or the profession. Whereas if I am taking it for purchasing sugar in my house, or for purchasing footwear, for purchasing textiles, fabrics, then it is for personal purpose. Journal entry varies based on that. Now when you pull out money from the bank, it is cash account debtor. To bank account. But then this cash, if it is for the business, I will retain it as cash account. I will reframe this as drawings account if it is for personal purposes. So the next entry in that case, either you pass the entry drawings account debtor to bank account, or if you pass this entry already, then it becomes drawings account debtor to cash account. It is like pure mathematics or arithmetic. Cash account is debited, cash account is credited. So effectively the journal entry is drawings account debtor to bank account. What type of entry is drawings account? It's a personal account. Mr. X, Ram's drawings account. So a drawing will go further to reduce capital. When I reflect my financial position at the end of the year, I will take up the opening capital, reduce the drawings, add the profit for the year, and arrive at the closing capital for this financial year. So this is how a withdrawal from bank, depending on classifying the purpose, is made. Two options: drawings to bank account, drawings account debtor to bank account, or in two parts, cash account debtor to bank account, and the businessman has taken it away for personal purposes, drawings account debtor to cash account. So insurance premium, loss of stock by fire, and drawings for personal purposes are special cases of accounting. We'll continue in our next session.